Okay, so let's take a look at this example. So in this example, the founder was granted 400,000 shares subject to a vesting schedule at 0.01 cent value, which equals $40 in initial value, 400,000 shares times 0.0001. The shares are subject to a 4-year vesting schedule where the founder will receive 100,000 shares each year he continues or he stays with the company. For this example, we're going to be assuming that the founder sells all of his shares once they're fully vested in year 4. We're also going to assume the shares appreciated in value over the 4 years to 50 cents in year 1, $1.50 in year 2, $2.25 in year 3, and $4 in year 4. Now let's look at the math with the 83B election. So the founder files the 83B election and recognizes the $40 of ordinary income in year 1. Now when he sells the shares in year 4, he'll receive $1.6 million less his cost basis, the initial $40 which he paid in year 1. And then he'll have a capital gain of $1,599,960. So if we assume 37% ordinary income tax rate and a 20% capital gains tax rate, he would owe $320,007. Now let's take a look at the same fact pattern but without the 83B election. So in year 1, the founder will receive 100,000 shares of stock at a 50-cent par value and will receive $50,000 of ordinary income. Since 100,000 shares will vest each year, he will only be taxed on the shares that vested. So in year 2, he'll receive another 100,000 shares, but this time the stock is increased in value to $1.50 per share. So he'll have to recognize $150,000 of ordinary income in year 2. In year 3, the stocks continue to increase and it's now $2.25 a share, so he'll recognize $225,000 of ordinary income in year 3. In year 4, now the stock has jumped way up to $4 a share, and he'll recognize $400,000 of ordinary income. So over the 4 years, without an 83B election, the founder will recognize $825,000 of ordinary income. Now if we assume a 37% tax bracket, that's $305,250 of income tax. Now when he sells the shares in year 4, he'll recognize an additional $775,000 of capital gains, which is the $1.6 million sales price less the $825,000 of basis. So using a 20% tax bracket, he would pay an additional $155,000 of income tax on this sale. So the total tax paid in this example without filing an 83B election would be $460,250. So the 83B election would have saved the founder $140,243. Now, of course, there are many variables to consider, but as you can see, the tax savings can be quite significant.